Hello, everybody. Welcome into commodity culture. Energy markets, a very hot topic these days. Very difficult to unravel and decipher in terms of what's going on with the war in Iran, Trump's social media posts, and the overall macro picture for the oil and gas sector. So there's nobody better to discuss this with than Josh Young, the CIO and founder of Bison Interests, an investment firm focused on public energy equities. Josh, we need to start with discussing this confusing relationship between oil markets, the war in Iran, President Trump's social media posts. How is it possible that so many market participants are actually following and believing these things coming out of the various administrations and seemingly acting on them? And it seems like there's quite a skittish sentiment among investors in the oil and gas sector because we're seeing oil down, as you were mentioning before we hit record today, around 10% over the last couple of days in the face of continued conflict. It looks like this thing is escalating, not being wound down. You mentioned attacks on Saudi oil infrastructure. Why don't you walk us through everything that's happening right now as you see it and why the oil price is actually down as a result?
Yeah, so I think the best way to think about it maybe is that there's now this oil market equivalent to the market saying of don't fight the Fed. And that equivalent is don't fight Trump. And so the market is sort of acquiescing to the Trump administration oil market narrative, sort of regardless of the facts on the ground and the facts in the fields and storage facilities and so on. And so it creates a really sort of challenging short-term environment and very potentially richly rewarding environment for longer term oriented investors, especially on the equities rather than the commodity. And then a very risky scenario for, let's say, global non-oil markets as the sort of intervention and interference with normal price signals is impacting storage decisions, investment and development decisions, and even sort of physical flows of oil in the short term. And so you have this very sort of challenging, I think, dichotomy for traders to navigate. And I think what they're choosing to do, again, is to not fight the Fed, except in this case, not fight Trump's posts. So I think that's how we get to this point where over the weekend, oil bulls were sort of sitting there stacking their coins, thinking about how much more money they were making from the Houthis hitting, I'm going to mispronounce these, but the Jizya, I think this refinery and export complex in southwest Saudi Arabia, and then firing at Yanbu, but apparently not hitting it. And then early yesterday, early at the start of the week, Abqaiq getting hit reportedly by Iraqi militias that are tied to, or terror groups, however you want to characterize them, tied to the Iranian leadership and control military IRGC. So a very sort of problematic situation from global oil supplies. And Abqaiq, this is just maybe the one point to clarify in all of this, the biggest maybe single point of confusion, which may have actually driven price yesterday and seemed to be amplified by folks that I would have thought would know better. Abqaiq was hit. Abqaiq was hit also in 2019. Abqaiq is sort of the single biggest point from a Saudi oil infrastructure perspective. It has the capacity to process up to 7 million barrels of crude oil a day. And recently, it reportedly was running just under 6 million a day. And people read it, it looks like, and interpreted Abqaiq as an oil refinery, as in a facility that turns crude oil into gasoline and diesel and jet fuel. And that's not what it does. It's midstream infrastructure. It basically pulls the water and impurities out of the oil and allows it to get transported and sold as crude oil. And so I think it's possible that some of the sort of extreme nature of the price movement for oil and maybe the strength also in refinery stocks and crack spreads may have actually been because people were misinterpreting. It's called a refinery, but really it's a processing and separation and purification facility rather than there's no diesel or jet fuel or gasoline that are coming out of that facility. The product of the facility is crude oil for transport and then typically export.
So it sounds like you think we could see more volatility ahead in the short term as these headlines hit the social media accounts and people react accordingly. There's also a lot of algorithmic trading going on in the market these days. Perhaps a lot of that could be attuned to headlines as well. But you believe in the long term, the market will be a waiting machine, and we will see oil and gas equities eventually price in fully everything that's currently happening on the geopolitical stage, because we also didn't talk about Ukraine striking some of Russia's oil infrastructure as well. So the long-term trajectory you see to the upper right of the screen, is that correct?
Yeah, that's right. Right. Sorry, I skipped the Ukraine hitting the CPC, which is this major loading facility for Kazakh oil as well as Russian oil. And then the most interesting news, maybe over the weekend, was actually Ukraine hitting an Iranian ship, and it was unclear. It sounded like it was weapons. And it wasn't clear whether it was weapons going from Iran to Russia or Russia to Iran. And it's one of those like cross situation questions of who's in a better or worse spot in terms of equipment and military, whether Russia's in a better spot in their war with Ukraine or Iran is in a better spot in the war with their neighbors in the US. And it's unclear. And Iran was supplying Russia with drones, and actually the Russian drones that they've been using to attack Ukraine have a, I think, Persian or Arabic name. And I'm not even going to try to pronounce it, but it's sort of noteworthy that Russia is using an Arabic named weapon, which is, again, just such a wild, crazy thing to think about all of the money and research and development that went into the Cold War weapons era and how far ahead the US and Russian militaries were perceived to be for decades. And then here we are with Ukraine offering to make cheap, effective drones for the US and drone defense for the US, and Iran supplying Russia. But anyway, that sort of cross-border, among some more cynical geopolitical analysts, they pointed out that NATO was one Iranian attack on Ukraine away from entering the Iranian war, that they may not care maybe at all about Iran striking the US or GCC countries, but that they would care tremendously if Iran attacked Ukraine, which they've been funding and arming and so on. And so anyway, just a very interesting, complicated situation. What is not happening, to be clear, and this is why my view on this geopolitical disruption is that it's not over, and that maybe at the current WTI oil is right around $81 as we're talking, maybe a little under that. That seems way too low relative to the current very sort of short-term and acute supply risk. I think that there's way more upside potential there, even sort of in the short term. And it is one of the more sort of extreme dislocations I've seen in my career from an oil price perspective, in terms of the reality on the ground with all of these different disruptions and then potentials for further disruption at the same time as or shortly ahead of a $10 down or 10%, actually sort of worked out to be close to both 10% and $10 move down in the price of oil over a very short period. So sort of shocking in terms of elevated supply risk, but then also declining oil price.
The sponsor of today's episode is ARC Silver Gold Osmium. Owner Ian Everard is praised even by his competitors as one of the most honest and level-headed bullion dealers in the United States. They have some great prices. You can see some of them displayed right now on screen. Take advantage of these specials today by reaching out to Ian at 307-264-9441 or by email at ian@arcsgo.com. Make sure to tell them, of course, that Commodity Culture sent you. And now, back to the interview. Do you think that because there has been such a large amount of underinvestment in the oil and gas sector for several years now, that the market is kind of looking at this as, well, the only reason oil is going up is because of this conflict? So, those who were thinking about entering the energy space might be sitting on the sidelines and going, well, let's just wait till this whole thing winds down. we could see oil drop back down to $60 range. Some people are even calling for $50 WTI at some point. And then we can get in, because the fundamentals for the sector obviously look good on the long term. For me, this whole conflict, it seems partially like a bit of a negative, because it's kind of obfuscating the underlying fundamentals of the sector and leading a bunch of market participants to believe, okay, this whole thing about oil, it's all about the war. I wonder what your thoughts are there.
So the one part that I would correct you on there is and then I'll get in, as the sort of thought process for investors and allocators and so on in considering the oil investment space. I think the broad decision by institutional investors and allocators regarding the energy space broadly, but specifically oil upstream and to a lesser extent midstream, is investment in the sector at all being essentially a bad idea. And ESG was sort of the excuse, but then there was just also the very poor trailing returns, really from 2012 or 2014, depending on when you measure the peak for oil in the last cycle, down to the lows in 2020. It was just an abysmal sector. It did horrifically. And depending on where you were in the sector, you're still, like, small caps are still down from when we launched Bison in 2015. The small cap index, PSCE, it's an investable ETF. It's down almost 60% in that 11 years versus, the stock market's up, 2x, 3x or something. And some tech stocks are up 10x or more or whatever. So I think there's sort of this longer term dislike based on chasing medium to long-term negative returns. And every cycle works similarly. It always has like a different flavor, but every cycle, you look back at the 1960s and like news reports and articles and analyses about how you didn't need to invest in oil. It didn't matter. There was tons of it. You would just keep getting it, sort of like what you were referring to. And then in the 90s and even into the early 2000s, there was still this discussion. There's the famous Economist cover of "Oil is Dead." But then, that was just a sort of emblematic sort of moment, but there were many years of analyses. I remember in my high school econ class in the late 90s being taught about how oil's never going over $10. And it's like, hey, wait a second, tell me more about this. Doesn't it deplete? And so I think there's sort of that long-term negativity. We've had these moments of oil prices and oil equities massively outperforming, and, my firm exists because we've been able to outperform even more than that in some periods. And again, this isn't a solicitation or whatever, but there's been amazing opportunities. But I think the general take on it isn't, when do I enter? It's that's dead and not interesting. And you see it a lot when oil prices rise. People get very mad. They feel like it's immoral for oil prices to rise and evil to want oil stock prices to rise, because it hurts the rest of us, sort of ignoring that there is this very, very large number of people involved, but also huge capital base for this industry that enables the rest of the economy to essentially function. And so it's not really about what we want, and it's certainly not immoral to invest in cyclicals that power the economy and enable very highly productive economic growth that makes people better off and so on. But I actually think that the bias very heavily is bearish oil and wanting to never invest or to purely just short the sector. And so I think when you think about what's going on with oil price and with energy stocks and so on, it makes a lot more sense with that as the backdrop, rather than, hey, like, people are just thinking about when to time it. And one other way to see that is when oil prices rise, you see, for the most part, people talking about how they're going to fall. And then when oil prices fall, you see people just talking about how they're going to fall more. And so as a contrarian and a value investor, this is fantastic. As someone who realizes that it's necessary to eventually catch up on the essentially $1 billion a day of underinvestment in oil, probably for the last decade, in exploration and delineation as well as development, as someone who recognizes the reality of that, it's a little scary in terms of how high oil prices will need to go in order to induce investment, but also to destroy demand to be able to make up for this sort of weird cyclical bias against the sector.
What is the situation right now with the Strait of Hormuz, as far as you're able to tell? I know you've been posting about that on X recently, and also the Strait of Bab el-Mandab potentially also going offline, and shipments through there being halted or severely restricted moving forward as well. How much are those two things? How much is the Strait of Hormuz having an impact right now? And assuming the Strait of Bab el-Mandab also gets essentially closed, how much more of a squeeze could that put on the supply side?
Yeah, so the Strait of Hormuz is mostly closed at this point. There's a fog of war, and there's sort of different accounts of exactly how much oil is getting through. And this changes a lot quite quickly. And there have been a lot of revisions. So a lot of the satellite companies and the Bloombergs and whatever of the world, they'll put out these charts and then they'll like quietly revise them without telling you. And so you'll see a chart from the same company that has a very different historical data than it did a week ago. So I'm a little hesitant to comment on that because one, I'm not doing that work. I'm looking at these reports and trying to draw the best information and actionable intelligence I can from it, but also then acknowledging a sort of deeply unreliable and, at least from a public facing perspective, not 100% honest set of reporting and data. It's just I think it's very difficult to know for sure. So I just wanted to caveat that it looks like flows are very low right now and that almost no tankers are flowing through. So maybe there's 3 or 4 million barrels a day of oil going through the Strait of Hormuz versus a pre-conflict close to 20 million barrels a day through the Strait of Hormuz. And then there's been redirection of oil out to the west coast of Saudi Arabia, to the Red Sea, particularly through the port of Yanbu. And so the Bab el-Mandab, which is the other strait between Yemen and Somalia. And so that's a choke point for getting oil out from the Red Sea. But there's sort of two questions. One, will that get closed? And the Houthis in Yemen, this sort of IRGC linked terror militant group, they were attacking tankers and other ships, and they announced that the Bab el-Mandab Strait was closed. But there's still some oil coming through it. The reason to sort of clarify that is that it's possible that the Houthis will shoot at tankers and further close the strait. It's possible they will allow oil to go through it, which some tankers have been able to get through. They've mostly been attacking Saudi flagged tankers. So it's more of a constraint than a closure at this point. But the bigger thing is less to me about hitting tankers and more about will they hit the East-West pipeline, which hitting Abqaiq does impact that. And again, it wasn't the Houthis that did it. It was a different IRGC-linked terror group out of Iraq instead of out of Yemen. But the distinctions, they obviously matter a lot to those people. But from a U.S. oil analyst perspective, how much to fund managers perspective, how much do I really care what they call themselves? It just matters if they're hitting the stuff or not. The risk is if Yanbu gets hit and or if the East-West pipeline gets hit and knocked out and potentially threatened to sort of forced offline like the Strait of Hormuz for a long period of time, because you can get millions of barrels a day out of Yanbu. It looks like it was running close to 5 million barrels a day, which is sort of its full capacity, let's say a month ago. And you can only get, it looks like, about 2.5 million barrels a day through the bypass pipeline in Egypt to get through essentially the Suez Canal, plus maybe a little more if you use much smaller tankers that are, allowed through the Suez Canal. Where the VLCCs, the like 2 million barrel tankers, those are not able to go through the Suez Canal, but the Suez Maxes, 400,000 barrels or something can, but obviously you have to do 5 of those for the equivalent of 1 VLCC. And I think there's also severe limitations on the number of those that can go through because they're obviously flammable and explosive and have other issues. So there's limitations on the transits of those through Suez. So there's severe limitations, but it's still potentially 2.5 or let's say 3 million barrels a day they could get through between the pipe and the Suez Canal versus potentially zero if Yanbu is knocked out and then there's just no Saudi oil going south or north.
Well, you've got the hat in the background. I have to ask, $250 WTI crude. Is this something that's maybe closer than it has been in recent history? And if we did get into the high triple digits, even into the $120, $150 range, the argument there is always, well, it couldn't stay there for long because it would just be so devastating to the global economy. It would kill demand so thoroughly that the oil price would have no choice but to fall from those levels. What are your thoughts there, both on your $250? I know it's not your personal target, but your hat's target, and the impact, the potential impact of high triple digit oil on the economy, and how that could affect the price.
Yeah. So the hat, it's sort of this idea that in every cycle for a cyclical that you get to a new inflation adjusted all time high. And it's not 100% of the time, but maybe more often than not, you pick it, gold, silver, uranium, copper, whatever, you get to your sort of new inflation adjusted all time high at the top of a cycle. And at that point, people are expecting even higher prices. They get disappointed. You go from underinvestment leading to higher prices to overinvestment leading to oversupply and much lower prices. And so the thought was, hey, the high price for oil in 2008 was around $147 a barrel, and there's been substantial inflation since 2008. So, 250 is sort of a round number for that. Who knows how much inflation we'll have in between now and the top of the next oil cycle. So that's sort of the thought process there. It's certainly not a, hey, I think there's going to be this geopolitical disruption and therefore this high price at this specific moment or anything like that. What I would point to is that historically oil cycles have coincided with geopolitical sort of supply disruption cycles and events. And so how much of it is from those, or how much of it is that at points where prices are elevated, countries and groups that are funded by higher oil prices or benefit from higher oil prices feel sort of enabled to exercise their physical or political influence in order to lead to even higher prices, but also to accomplish the various other goals. I think that's debated a lot, but it's certainly, you can look back to the 1970s extreme sort of oil cycle. You can look at the 2000s and sort of the end of that cycle around the Arab Spring and a lot of revolutions and disruptions and so on, and the U.S. invasion of Iraq in 2003, and some of the wars and disruptions around that in the most recent cycle. So, do I think that we're going to get $250 a barrel oil from the current disruption? I would say probably unlikely, because the Trump administration really proactively doesn't want that. And they seem willing to sacrifice military objectives and alliances and strategic objectives in exchange for a lower oil price. So probably not likely in the short term, just because they'll literally, one of the thoughts yesterday as oil prices went down 8% despite these multiple infrastructure hits was that there was a plane on its way to Tehran with billions of dollars of cash on it, US dollars. And that's happened reportedly a few times already, this conflict. There were reports that Qatar sent $3 billion in cash, which is why then shortly after those reports, which were of course vehemently denied, magically Qataris LNG tankers were making it through the Strait of Hormuz on the Iranian side, where previously they had been attacked. So, maybe it didn't happen, but something was on that plane, and Occam's razor says it was the billions of dollars that were reported. And then there were reports also that UAE had done something similar. And I would point out that in the first round of the US-Iran war, UAE was hit very, very heavily by Iran. And in the most recent round, Bahrain and Kuwait were hit very heavily. And at least from what I saw in the reports, UAE was hit very lightly or not at all. And it might have just been at US bases. So it's possible those news reports and other sort of open source intel reports were wrong about UAE sending huge amounts of cash to Iran. Again, the important part is that on this is one, that it's impacting the policy and impacting the actions of the military wing of this, Iranian totalitarian dictatorship. So people say, oh, they're very ideological, but they are willing to change what they are doing measurably based on billions of dollars of cash showing up. So that's when you think about what the Trump administration could do in order to avoid ultra high oil prices, that's certainly a possibility. And maybe it isn't coming directly from the US. Maybe it's from Dubai or from Qatar, and maybe they call it, sanctioned, money from sanctions collections or something, but net effectively it would be money from the US. And the one other thing to point out on that is that this latest round of attacks from the Houthis appears to have been equipped and funded by the IRGC. There were planes that were coming in to Yemen from Iran that were shot at by Saudi Arabia, likely because they knew they contained money and weapons and so on, and people to lead this or coordinate or whatever. And so the sort of weird possible sort of left tail for the markets and right tail for oil risk is that you bribe them to try to secure your oil supplies and to not get hit. And they say, sure, we won't hit you. And then they take your money and send it to the Houthis, and I forget what they're called, but to the IRGC-linked militia in Iraq, and maybe they send it to Hezbollah in Lebanon, send it to Hamas in Gaza. And then suddenly those guys are firing rockets or missiles with deadly precision at the most critical energy infrastructure targets, despite bribes being paid and so on. So it's a complicated situation, but I'm going to err on the side of the Trump administration being able to capitulate sufficiently if they view it necessary to be able to prevent oil prices in the short term from going anywhere close to $250 a barrel.
So do you think a scenario where we could see 250 WTI is perhaps in the aftermath of the war, prices drop off initially, complacency sets into the market, and then the realization eventually comes that, hey, it's not just the war that was causing oil to go up. We have a fundamental supply-demand imbalance here. Perhaps that could be a scenario where we'd see 250 new all-time high. What are your thoughts?
Yeah, I mean, we saw that in 1973, where people blame OPEC and the Arab oil embargo, and it's sort of interesting. The Yom Kippur War in 1973 ended, and people said, "Oh, it's because of that," and then they said, "Oh, it's because of the oil embargo." The oil embargo ends, and then oil prices go up like 3x. So you look at the timing of this, and oil went up a ton after several months after the end of the Yom Kippur War. So ending hostilities does not guarantee anything from an oil price perspective, even in the medium term. And what will happen exactly to oil prices? If there's a ceasefire, we get back to this sort of very weird, clearly fake or staged or something MOU that we were in a few months ago. Maybe you get back to oil in the high 60s, low 70s, like we saw, maybe. But inventories are down even more. There's even more evidence of infrastructure and supply at risk. And then, in a few months after that, if it held, which again, the Yom Kippur War was the last major, I'm going to get some flack for this, but the last major basically war between Israel and its neighbors. Like after that, they did, this fight in Lebanon with Hezbollah that was more of like attacking a Iran proxy terror group. It wasn't really similar in, West Bank, Gaza, whatever. But the last major sort of regional war was 1973. It ends. Israel wins. They maintain control of the West Bank. They get additional sort of territory in the Golan, and then oil prices go up 3x. So then maybe I'm getting that wrong. Maybe they were already up and they pulled back and then went up 2x or whatever. But I'm just sort of remembering the price chart and the trajectory. And so what is it that happened? Well, you were in this situation where there were already supply risks. There had already been massive underinvestment. There was already a big move higher in the precious metals, which I know many of the viewers on your channel are very interested in. And I think I was on your channel a number of months ago prior to the war talking about how the elevated price of gold could be a precursor for an elevated price of oil at a time where everyone was bearish oil. Everyone said, hey, this is nonsense. There's no way. I'm like, hey, look at the history. Every time you have gold go up a whole lot, wait a few months or maybe a year and you end up with oil up a lot. And we didn't have to wait a year for that. And I think you end up with these sorts of periods of underinvestment, and then combined with currency debasement, combined with supply challenges and elevated perceived supply risk. And the combination of those things can lead to much higher prices. And actually, in the early 1970s, there had been major government intervention in commodity markets. Gold, there were physical sort of links that broke. And then for oil also, there was intervention. There were price controls in the US. That's part of why people blame OPEC. And again, I'm not saying OPEC is blameless, but OPEC wasn't the reason that there were gas lines in the US. There were gas lines in the US because Nixon imposed price controls, and price controls always backfire. Sometimes it takes a while, but they always backfire. So people forget this stuff, but we're in a very similar situation where you hit a lot of these different items on this list. And hopefully this is the end of regional conflict in the way that 1973 was, where, conflict, relatively speaking, declined significantly. Just the scale of conflict and the number of participants and all that stuff really, really de-escalated after 73. Hopefully we're in a similar situation. Probably unlikely. It feels sort of fanciful to think that, but maybe they thought that in 73 that it would be unlikely that would be the end of those sort of big wars. But if it's not, then that's even more risk and even more sort of potential for the upside. But my thesis was never, hey, there's going to be this massive war with Iran, and therefore there's going to be 15 million barrels a day of oil offline. There was always a risk of Hormuz closure and Iran supply disruption, but that wasn't the thing that would get you to 250 WTI. What would get you to that is $1 billion or $500 million a day of underinvestment, essentially since 2014. So running on 12 years now, with some years where there was even more, maybe $2 billion a day of underinvestment like 2020, and with also major depletion of large fields. And, I have Twilight in the Desert behind me, a book written by Matt Simmons about how Ghawar, the largest oil field in the world, would go into decline. And people don't talk about it much, but Ghawar, I think at the time he wrote that, was producing something like 3 million barrels a day, and now it's producing 1 million barrel a day, something like that. So it actually played out. It just, there were other things that happened in the interim. Prices spiked after he wrote that, so he was right. But then there was shale. Well, here we are. Shale is sort of experiencing a Twilight in the Desert moment, in many respects parallel to what Matt Simmons was identifying. And again, he wrote that way before Ghawar really collapsed. He wrote it as sort of productivity was starting to peak, and there were some early indications. And we've seen now since 2020, per foot well productivity has declined in oil shale and frankly gas shale in the US. And that decline is continuing even with improvements in technology. It's being offset by longer laterals. So instead of drilling a 1 mile well, companies started drilling 2 mile laterals. So, let's say 1 or 2 miles down, and then instead of 1 mile, they go 1 and then 2 miles, and then 3 miles now is sort of more standard. And companies are starting to go towards 4 miles, but there's very obvious problems with this. One, you deplete your inventory way quicker, and there is not infinite inventory. There's a lot of it, but there's a finite amount of it. And if you drill 4 mile wells, you're depleting your inventory twice as fast as if you were drilling 2 mile wells, right? You just by the mathematically. But there's also a problem, which is that as you get to less productive rock, you're maybe getting similar initial production rates from those, let's say, 4 mile wells as you got from 2 mile wells 5 years ago, 10 years ago. And in some cases, you're actually getting bigger initial production rates, but your 1 year rate might actually be a lot lower, even though you have twice as much lateral. So why does all that matter, right? Sort of a bunch of industry jargon, whatever. Well, what it means is that we're pretty similar from a U.S. shale perspective, not the same as this rollover in the Saudi oil fields that we saw in the early 2000s that was the lead up to much higher prices, a re-rate completely from $10 oil in the early 2000s to 147 at the peak in 2008. We have not seen sustained prices anywhere. Yeah, we had a moment where prices were negative during COVID, where the government shut down everything. But from a pure market perspective, we have not seen anything close to the prices we saw in the late 90s, early 2000s. And I think we're in this sort of next wave. And if you look in the 70s, it was similar. You had oil at $3 or something, and then it got to, I think, 40 by memory. But then it fell, but it didn't fall to 3, it fell to 10. And so 10 didn't feel great after it had been at 40, but it was a whole lot better than 3, or a whole lot higher than 3. And so I think there's a lot of risk here that we have some sort of big reset and big sort of price shift higher. And so that's really what that 250 WTI hat is about. And that's really my thesis. I mean, geopolitical disruptions help in terms of pushing this along, and they certainly are a potential component of much higher prices, but I don't think it's necessary. I think it's just the pure cyclical underinvestment. And then this cycle has been more extreme, both because of the ESG pressures for endowments and other sort of professional allocators to underinvest and withdraw money. And a lot of investment banks and brokerage firms and others have also sort of pulled capital, insurance companies, et cetera. And then you have the horrific negative returns that were both cyclical, but then also likely amplified by that divestment, that are, I think, keeping more sort of commercial returns oriented people who are looking at sort of the 3, 5, 10-year trailing returns and saying, hey, why should I even bother? The sector's down, the small caps are down 60% and the large caps are up 20% in the last decade. Like, I could earn that in bonds, not realizing that that decision in that moment is contributing to, likely, but not guaranteed, but likely based on historical cycles, and I don't think this time is different, returns that may be astronomically higher than they were over the prior 10 years. And that may also lead to very disappointing returns in bonds, conventional sort of S&P 500 equities, and various other places that people are sort of hiding in, or where they're chasing these sort of 1, 3, 5, 10-year type returns, which is unfortunately how most of that asset allocation process looks like.
Given everything we've discussed today, which areas of the energy space, which types of companies do you think present the greatest value proposition at present? Are there still bargains to be had out there? And would you be, let's say you're a new investor to the space, we don't give investment advice here, but would you be sitting on the sidelines during this whole all this geopolitical upheaval, waiting for things to calm down? Or do you think you'd want a position in energy as part of your portfolio regardless?
So we're buying right now stocks that in many cases are cheaper than they were before the start of the war. Not just on valuation, on cash flow, but actually the stock price is lower. And in many cases, these companies just experienced a cash flow bonanza. So they have less debt, fewer shares outstanding, more production, more run rate cash flow, but even measured at the 60 or 65 or whatever we were at before this conflict. And they're cheaper. So it's phenomenal. I think there are tremendous bargains out there, but also very, very expensive stocks that are very heavily promoted, and in my view, very risky, where a lot of the good things from a commodity cycle perspective I was just describing may already be priced into some of those stocks. And so I think it's getting harder from a broad market or even a subsector perspective to say, hey, XYZ subsector is mispriced, because, I like small and mid-sized Canadian producers, for example, because historically those were very out of favor and mispriced. And now some of them are very out of favor and mispriced. And I think it's not that the ones that are expensive are bad. They're just not cheap anymore, and they're very popular. If you tweet something positive about oil, for example, post on social media, hey, oil's going up, people will post stock tickers at me when I post. And those stock tickers, like if you're looking for a list of the least interesting, most expensive stocks, That's like a good starting point for those. The flip side is there's a whole set of companies that are very, very cheap that are overlooked in some cases for good reasons. And in other cases, they're just completely mispriced, misunderstood, and there's great opportunities. Similarly, on the services side, I'm really bullish certain parts of the value chain for oil because that dynamic I was describing on the declining per foot well productivity means that you're going to need a lot more rigs in order to get the same amount of oil production as you were getting. And it's not perfect because, yeah, maybe you'll redirect rigs to other places, but there is this tendency to try to sustain production from existing fields or known fields for as long as possible. There's a historic tendency. It's not just sort of a emotional bias or economic incentive. It's also real observed behavior over the oil industry's history in the last 60 years that it's been commercial. So I think the rigs are really interesting. The pressure pumpers are interesting. Some of these other parts of the oil value chain, so the companies that own the physical drilling rigs that oil companies hire to poke holes in the ground to drill wells, and then companies that are hired to stimulate the rock, to frack it, to clean out the wells and bring on production or restart production, to manufacture some of those components. There's really interesting companies within those sets, and there's also really expensive companies that, in my view, are either uninvestable. I don't short stocks, but that maybe are more interesting on the short side than the long side. So it's a very interesting dynamic market with a very wide dispersion of valuations, as well as, in my view, a very wide dispersion of relative attractiveness of opportunities.
Well, for people who want to dive into the individual companies that you're investing in, Bison Insights is a great newsletter service that dives into your thesis behind the energy sector. You talk about specific names. Why don't you tell us about that as well as Bison Interests?
Yeah, so my day job is running an investment fund at Bison Interests, and we've done it for 11 years. We've done really well. Again, none of this is solicitation. Past performance may not be indicative, but we've done really well relative, especially to this small cap sector that we're focused on within oil and gas, upstream, midstream services, sometimes downstream. And so what I realized a year ago was I really like talking about these stocks, but it becomes all kinds of problems to tell people about individual companies, sort of one-off. You tell someone, hey, they ask you, hey, like, what energy stocks do you like? And you mention one or two you've been buying, and then they go up 2x and you sell, and you forget that you even talked to them about it. And 2 years later, you see them and it's down 50%. They say, hey, what'd you do? And you say, what do you mean? Why didn't you sell? So I found that from a social perspective, and then also there are just so many interesting opportunities to write about. I decided to organize my writing efforts and to start to publish a newsletter, which I charge for, but it's mostly for fun. It's sort of weird pricing these things because from an institutional perspective, it's massively underpriced. And from a retail perspective, it maybe seems expensive, but the ideas have done extremely well. And again, past performance may not be indicative, but I created a composite of the ideas, and I think they're up it's up 70% versus the sector up 30%. And the market up 10% or something since we launched the newsletter a year ago. So it's done well. The ideas I continue to do well. I'm really excited about the ones I've been sharing, and I see a lot of potential upside. I've exited a couple of the ideas and published that as well. One was up almost 10x, but not quite, and one was up 3.5x. So that helps to lock those in. And as my friend Lish Shrub says, writes another newsletter, it's important to give thanks in the market. So when you earn a great return, it's important to take some or all off the table. And so I've shared a number of different upstream and services and downstream stock ideas on there. And it's set up to help inform and for people that are interested in the sector. Actually got a lot of family offices and institutional investors and fund managers that are subscribers on there too, which is sort of an interesting, XYZ CEO or CFO of a publicly traded oil company or private oil company will occasionally message me and say, hey, Josh, you're right about this thing or wrong about that thing. So it's pretty fun to see. But anyway, that's what I've been up to on Bison Insights.
Great. Well, I'll put a link in the description below to Bison Insights as well as Bison Interests. Josh, as always, fantastic conversation. Thank you so much for coming on the show.
Thanks for having me. I really appreciate it.
Thank you for joining us today. This episode brought to you by ARC, Silver, Gold, Osmium. They have some great prices on gold and silver bullion products. You can see some of them on your screen right now. These are subject to change and well supplies last. So reach out to owner Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com. Make sure to tell him that Commodity Culture sent you. And we're building a community on WhatsApp. Join the Commodity Culture WhatsApp group. You'll get the chance to submit questions for upcoming guests, as well as be part of a community that is there to give each other investment ideas and feedback. So the link is in the description. Join today, and I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.